Good day and welcome to the Big Picture Report for the period to 30 June 2024. In fact, we're going to go slightly beyond June of 2024 because there's quite a bit that's been happening that is quite important. All right, so starting out as we always do with the political outlook, we spoke in our December review and the outlook for 24 about the fact that over half the world's population, particularly those who were eligible to vote, we're going to be going to the polls. So far, we've seen the story largely play out as expected. If you look in the UK, Labour did very, very well, essentially walking it, and that was much as expected. In terms of the European Parliament, we saw a bit of a jump to the right, and I think that importantly prompted a bit of a sort of knee-jerk reaction from Macron, calling a snap election in France that nearly, from his point of view and the centrists, it almost ended in a disaster with the far right doing very, very well. In India, as expected, Modi's BJP is in coalition. They did very, very well. Modi once again re-elected, and no surprises, Russia saw Vladimir Putin elected as Russian president for the fifth term with something like 87% of the vote. The big one, of course, the one that we all really are interested in, is what's going to happen in the US with the US presidential elections in November. Speaking of which, quite recently in July, in fact late July, Biden stepping off the stage to make way for Kamala Harris as the Democratic presidential nominee. From our point of view, it still feels a little bit like picking your poison. In many ways, we feel that the US presidency has become more about personality rather than party policy and coherence. So we still feel it's a little bit like picking your poison between the two presidential nominees. So our reading of the situation about what we think Kamala Harris and Walz would have to do to keep Trump from moving back into the White House, I think it's really just broadly appealing to minorities, moderates, women, and independents. But many would argue, and I suppose there's a lot of merit in this, that all she really has to do is put a coherent message out to anybody who's an anyone but Trump. And I think that would be all she really needs to do to prevent Trump re-entering the White House. I think the departure of Biden really saw a massive turnaround in the polls. Biden was lagging, particularly in some of those key battleground states. This data is slightly stale. It looks as though Harris and Walz are doing a lot better than Trump and Vance. As you can see, where Biden was trailing quite badly in quite a few of those battleground states by a good few percentage points in most cases, is actually, we've seen that turn around quite significantly in places like Michigan and Wisconsin and Pennsylvania, either swinging in the polls at least Democrat or Harris, or at least being very, very tightly balanced. So definitely Harris is doing a lot better than Biden was at the end of his tenure or potential nomination. Okay, so a lot of people would ask why we're so obsessed with the US presidential election, and the bottom line is it matters greatly. Firstly, from a policy point of view, we saw Trump following a couple of, let's call them populist policies, in terms of putting America first, and that's very noble, but it also, if one has to be honest, resulted in a lot of what we believe to be potentially lasting pain in the form of deficits, for example. It also, quite importantly, we believe will set the tone for what happens in the Middle East, and very, very importantly, what happens in the Ukraine. I think Trump has indicated that he's not very keen to continue supporting that, whereas a lot of scholars and watchers are of the view, as we are, that Ukraine really matters, because if Russia were to triumph there, it would set the tone for more aggression in Eastern Europe. As we've indicated, and we'll talk a lot more about it, but there was a time when the Republicans stood for fiscal prudence, balanced budgets, That wasn't the case. If you look in the Trump administration, we need to concede that obviously COVID happened, but the combination of tax cuts and fairly aggressive spending didn't leave the US in a healthy position. We've seen a massive ballooning in the debt, as we're just going to discuss in a minute. And then the important one from our point of view is trade tensions and trade war with China. Not only isn't good for either of those two economies, but it could also cause a bit of a stall in economic growth and confidence in China at a time when the world, as we'll see in a second, I think really needs it. Okay, so the political picture is one of, generally as expected, no major shocks. A couple of, I suppose you could call them anxious moments in parts of Europe, but generally all eyes on the US. All right, so if we look at economics, the truth is the themes that were true in December are still true. Inflation is lower, but still above the levels that central banks are targeting. Interest rates are starting to fall, particularly market-driven rates. Economic growth outlook is not spectacular in the world, as we discussed in December. In the December review, we really do need China and India to do a lot of the heavy lifting. And then deficits and debt are becoming a problem, and we believe more people are actually starting to focus on those, as we'll see in a second. What's new, though, is I think growing fears that the Fed is actually behind the curve, that they should have started cutting. But I think the Fed is trying to follow a script and also leave themselves with some ammunition in the armory. There's also allied with that fears that the US growth could surprise on the downside. And there are also questions on whether China is actually doing enough or is able to do enough to really stimulate growth in this sort of post-export-driven industrial world. Very quickly, inflation has moderated significantly from when we last presented the big picture about 6 months ago. If you look there, the US still above target, but not massively so from those very elevated levels, courtesy of the inflation spike due to the Ukrainian situation. UK is pretty much back in at the target level, having come off quite significantly, but obviously quite a few moving parts, as we'll see in a second. In the Eurozone, still slightly above target, but it's been in zone for quite some time. And as you can see, a couple of percentage points or a percentage point or two below the US, and then in SA still above the midpoint, but as we'll discuss later, looking a lot better. The one thing that we feel is worth remembering is the fact that wage growth and wage demands are definitely elevated. The chart on the top there is US wage growth, as you can see in the UK at 6%. That table is quite difficult to read, but you'll see in parts of Europe 6-7%, and even in the US there's definitely more wage inflation than other traditional inflation like food and so forth, and that could actually be could fan or fuel inflation over the next period. Having said all of that, some central banks, being, for example, in this slide, the UK and the Eurozone, have already started cutting rates, but both the US and South Africa are still taking a wait and see, and really because both of them are above the midpoint. If you look at the US yield curve, from where it was a month ago, it's ratcheted down, but from where it was 6 months ago, it's down generally, but more in the shorter end of the curve, but definitely down on where it was a month or so ago. Looking at the 10-year US Treasury yield, it's come down, but interestingly, that is a 20-odd year chart, and as you can see, definitely elevated from all the levels we've seen over the post-COVID, the post-GFC, post-COVID world. So we definitely seem to have moved into a higher yield environment, and I think part of that is because inflation seems to have reset at slightly higher levels, but also, as we'll discuss, I think some anxiety growing around debt. Global growth, a difficult chart to read. global growth is still tepid, is probably the best word. If you look at 2024, markets still penciling 2.2% for the US. We think it might be a little bit optimistic. China's still, battling at under 5, but 2025 might be a slightly tougher year at 4.5%. But as you can see, India really is becoming quite an important driver for global growth, with GDP for 24 through to 26 around the 7% mark. Elsewhere, Europe generally looking a little bit dull. If you look at the simple average of the top 10 economies, 2.1%, but if you strip out China and India, you're down at about 1.1%, so not too far from what we would almost classify as stalling speed. And then looking at the rest of the G20, some pockets that are really good, but on average probably closer to around the 2% mark. So I think the key message from this is that the world definitely needs China, particularly to grow a little bit stronger. As you can see, those trends are for far more muted growth, but as we've said before, when you're the second largest economy and of that scale, to still be growing at 5% is some feat. But the question is, and it's something that does nag us a fair amount, is what is the stall speed for Chinese growth? And I think we're probably not too far from that. But on the good news front, at least we've seen the Chinese authorities, particularly on interest rates, move quite significantly over the more recent past. Okay, we highlighted this in some detail in the December report, and we're going to re-examine it simply because it's such a big deal. Looking quickly at the US example of deficits and debt, but this is true for many other regions, the UK and Europe as well. So it all basically starts with spending more than you have. In the words of my late father, it comes down to having champagne taste and beer income. As you can see, deficits have been very, very persistent in the US for an extended period of time. More recently, due to COVID-induced spending, obviously those deficits widened, but unfortunately, that has a lasting legacy, if you want to call it that, and that's in the form of debt. And as we said before, US debt will only become an issue when it becomes an issue. As you can see there, US average monthly interest rate is definitely on the way up, and that together with the chart above that, which is the US interest payments as a percentage of revenue, getting dangerously close to that sort of awkward level. So if you don't believe what we say, then listen to some of the more astute people in the world. And in fact, Jamie Dimon, we believe, is really more often than not right on point with his analysis and calls it like it is. He's the chair and CEO of JP Morgan. And basically, he's been warning that US debt is an issue that has to be addressed. And if the US authorities and the nation doesn't address it, the markets will deal with it. And that will be a lot more catastrophic. And then Ray Dalio, who's a legendary investor, also worrying about the US debt picture becoming a real problem. And sadly, this explosion in debt over the last 20 years hasn't actually resulted in a massive investment boom. On the right, you can see gross capital fixed formation. It's not a perfect proxy of investment into the economy, but it gives you an indication that this massive increase in US debt up to over $30 trillion has not brought with it the kind of capacity that you would expect. And as you can see on the left-hand side where the revenues are, and you can see how much the budget deficit is exceeding, and a lot of that is around social welfare. So, if you look at things like Medicare and Medicaid have grown massively over the last 20 years. So our view is that the US deficit and debt is a problem that cannot be ignored. If markets ignore it, they risk ignoring it at their peril. A lot of people, particularly those following the sort of 60-40 balanced portfolios, have seen massive underperformance because of the impact of rising yields on those portfolios. We spoke before, and we will in our offshore markets piece and our asset market reviews, We have invested in some longer dated US Treasuries, and we've already, as you would have seen there, made some gains on the fairly short term. But we definitely think that deficits in debt has to be addressed, and it starts with the balanced budget, or at least moving, away from excessive deficits, and that requires fiscal prudence and more revenue, which is something that we think will go down very well with we're being sarcastic, of course, with the electorate. And a little bit of economic growth would help, but it needs to be more than 1.5–2%. As we indicated, one of the new things that's worrying markets is the risk of a sharp slowdown in the US. We believe that those fears are unwarranted, they're a little irrational. We'll probably still see reasonable growth, and in large part, the dot plot on the right-hand side there supporting that view that the Fed will start accommodating quite soon, and that will obviously give the economy and confidence a bit of a boost. And I think a lot of the fears were caused by the most recent non-farm payroll data that came in significantly worse than expected. It's that last point there on the chart. But then after that, we've subsequently had initial jobless claims coming in a lot better. So I think the problem is that the world markets are in this Goldilocks scenario. It's not too hot, it's not too cold, everything is just perfect, but that is a fairy tale. But it's more important from a market's point of view, possibly, than from an economic growth or an interest rate point of view. So our conclusion is that there's definitely a little bit more uncertainty around, and visibility is a little bit poor, particularly until the US elections are behind us. So some skepticism is probably warranted, but we don't think that you need to be fearful. Right, then looking at the local picture, many times we thought that the light at the end of the tunnel was a light, but it turned out to be a train. We're increasingly of the view that the South African story is getting better. A few of the positives, sentiment post the GNU, definitely positive, and that's why this report extends beyond the end of June, because the GNU is only really in effect in July. We've seen the Rand do better on the back of that. Inflation is moderated. We've had no load shedding for over 100 days, and they get the sense that the SOCs are being not fixed, but at least are facing their demons. So there's an African proverb that says that the GNU, the wildebeest, is made up of the spare parts of a whole lot of other animals. So it's got the stripes of a zebra and the mane of a lion and the tail of a giraffe and so on. But just like the wildebeest, the South African Government of National Unity is made up of a strange mix of parts. You can see some of the parties there, but it seems to be working. It's not perfect, but it is definitely ushering in a new era of South African politics. It won't be without wobbles. Our view was that the ANC probably went into a GNU mainly because I think many factions within the party and in society would find it untenable for them to have simply gone into a coalition with a DA or another. So I think a GNU was a more pragmatic solution within the party, but we also believe that it's a right approach for South Africa. Our scenario 4 was the one that obviously played out, which was one that the ANC got significantly less than 50%, but would have to form a coalition with some smaller parties. But of course, there are one or two bigger ones in there, so the new official opposition is no longer the DA. We've had no real data, economic data, since the GNU was formed, although we are starting to see a little bit of a pickup in the Rand, and we expect to see PMI and some of the other leading indicators also improving, because there's definitely a more positive mood, albeit anecdotal. We've always said that the share price of a country is basically its currency, and here you can see the Rand doing a lot better. And we was just reminded that being overly bearish and assuming that Rand's always going to weaken is a dangerous scenario, particularly if we're able to get our act together. Local inflation is back in the band, as you can see in that 3 to 6, but increasingly, and we're very supportive of this idea that rather than having a 3 to 6 band, that the Reserve Bank rather focused on a number which seems to have been the midpoint of 4.5%. So although we still, from a headline inflation number point of view, coming in at 5.1, the good news is that if you look at core inflation, it's actually on the right side of the midpoint, and we believe that the South African Reserve Bank will probably follow the Fed. It's a little bit frustrating because we were a little ahead of the curve in terms of rate hikes when it hit, but we believe we seem to be following the Fed. So we would expect rates relief quite significantly or quite soon, and it to be quite significant. The FRA curve, which is the forward rate agreement curve, is definitely reset. It's adjusted quite significantly since December 23, and that's quite good news. As you can see, over 100 basis points of rate cuts already priced in. The South African yield curve obviously responded very, very positively to the GNU. Across the curve, both on the compared to the 1 month and the 6 month, but still we believe quite good value, as we'll discuss in the asset market review, in the medium and longer dated. Our growth forecast we think is improving, and we still think it's obviously well below what we need as a nation to make a dent on things like unemployment and really to make a difference in the lives of our people. But for the first time in a while, I think we can see a roadmap to higher growth. And that's really concluding with some of the things we believe could be GDP drivers and detractors. Obviously, we can get a little bit more policy certainty. There are problems, obviously, with NHI that was pushed through just before the elections. But we believe that the GNU, as a group of adults in a room, we may be able to make some real progress on some policy reform and also mobilizing those policies. Very, very importantly, we expect to see some rate relief quite soon. I think generally markets believe we'll see 2 cuts in 2024 and more to come in 25. You get the feeling, evidenced by the improving conditions in load shedding, that Eskom is improved and Transnet also. It looks as though things are turning around there. There's definitely a new theme in South Africa, and I think that is that government alone cannot fix a lot of the infrastructure issues and even the SOC challenges. And there's definitely a new mood of public-private collaboration, which we believe to be a potential enabler. Confidence levels are improving, even if it's just anecdotal at this stage. And then, global inflows, if you look into a bond market, for example, but also into GDFI projects, we think could be a real catalyst. Some of the things that could hold us back and see us disappoint once again, obviously global shocks, always the risk. Commodity price weakness, although it looks as though we're forming a base, and for example the PGM's demand for copper and a couple of other commodities looks to be robust, so we're not expecting an implosion, although we do think that some commodities are maybe in a little bit of a short-term supply demand squeeze. Rand weakness, although we don't really see that in the short term, but Rand weakness would trigger more inflation, and that would sort of throw cold water on the rate cut scenario, although we don't see that, at least for the next 6 months. If the GNU was to implode, which would be obviously catastrophic, because we go back to dysfunctional politics. Municipal and local authority decay is a very, very real issue. Living in Johannesburg, you see that decay. And as one headline said, city of Johannesburg is just too big to fail. It needs to be fixed. And if SOCs continue to erode, which as we said, we don't really anticipate. So in conclusion, we've got the wounded lion once again on this. We expressed the view at our last one that there was a lot of bad news baked in. We reiterate that view. South Africa is resilient, and we believe that a little bit of good news would actually go a long way, and we could actually see GDP back at 3% without too much good news happening. So we trust that this would be of use. The next one in the series will be the asset market review, followed by the offshore, local, and local portfolio reports, as well as the Kerner BCI fund. We trust this was of use, and we look forward to your feedback.